Hello, this is Squander Invest. Today we'll be talking about stocks that are undervalued today. So let's start off with the one on the left, which is Palantir over here. Palantir over here is currently a stock that is trading at around 200 times earnings, 400 times earnings, correct? So it's trading at 400 times earnings. And if you were to look at the Palantir's earnings report in the last quarter as well as the last full year, they had around 196 million of interest income and around 450 million of net income, meaning to say that approximately 40% of their total net income is coming from just interest payments. So the actual income from the operations is only about half. So for me, Palantir is a strong avoid. It's a company that's trading at 400 times earnings. That's just crazy. Unless they can continue growing at around 40% over the next 10 years, which I think it is impossible for any company, then Palantir will be a buy today. But otherwise, Palantir is a strong sell. It is a company that is extremely overvalued, so I wouldn't be going anywhere near this company right now. There's a lot of momentum behind it. It is a stock that is trading a lot more momentum than actual fundamentals. But yeah, it's one that I wouldn't touch right now. Next company that we'll be looking at is FICO. So what FICO basically does is it rates consumer credit score. Basically, it just rates the consumer debt. It rates the ability for the consumer to pay back all their loans, their car loans, their house loans. And then for FICO, it is basically a monopoly in the US in terms of consumer ratings. So you have S&P Global and Moody's, they rate companies' debt, and then for FICO, they rate consumers' debt. So whenever a consumer, like for example me, want to go and get a loan from like a bank to buy a house for my mortgage, I will need to get a FICO score first. And the FICO score actually costs only $7, and the house itself costs around maybe $500,000. So if you were to compare the $7 to the $500,000, it is extremely cheap. It is only a very small proportion. So even if they were to raise it up to around $200, I think it's still manageable. Meaning to say, I believe the consumers will still pay for it because $200 relative to a $500 purchase is like nothing. But the problem with this company over here, FICO, is that it is trading at an extremely hefty valuation right now. So it is trading at 80 times of earnings, 59 times forward earnings. So although this company has incredible fundamentals, incredible business quality, revenue has been growing quite steadily as well. Net income has been exploding because they've been increasing all their prices non-stop, and then you have EPS growth of around 20% every single year at this point already. I think FICO is a company that is overvalued right now. I would buy it closer to around $1,300 when think it is still overvalued, maybe slightly between fair value and overvalued. But at that price point, it will offer me a lot more reward as compared to the risk that I'm taking at that price. But for the current price, $1,800, I think FICO is a strong avoid. I wouldn't touch it right now. It is under the overvalued category. Next company is Google. So Google over here is a company that is trading as though it is going out of business. So year to date, it is down 11%. From all-time highs, it's down, I believe, around 20% already. And it's currently trading at 20 times of earnings. So if you're to look back at the history of Google, it has never traded at this low valuation apart from the 2022 US tech crash. So Google is a business that is growing around 13% revenue over the past few years, 35% EPS growth over the past year as well. And if you were to just look at Google's fundamentals, I think it is amazing all around. They have zero debt. It is a company that is facing challenges, of course. You have your ChatGPT, you have all your LLMs that may be taking market share away from Google. But if you think about it on hindsight, Google has always faced competition from companies like Amazon, Meta, which have been taking market share away from Google as well. So I don't think it is a new challenge that Google is facing right now. And I think it is a very durable business. So if you look over here, the EPS is around 8.05. So let's say Google slows down its growth to around 13%. So if it slows its growth to around 13%, 13% I think is extremely reasonable. And I believe they bought back a lot of shares. So their buyback yield now is around 2%. And I believe they will continue holding it at around 2%. So that is just 11% of net income growth. And so for Google over here, it has always traded at a low valuation. So let's say if we were to put it at a 22 times of earnings, at the current valuation today, you're basically getting around a 14% return already. So a 14% return will likely be market beating. You will likely double your money in 5 years. So I think Google right now is presenting a very good opportunity. And for me, Google is one of the stocks that I will place over here, which is in the undervalued category, and it is one that I'll be buying right now. Next company, Amazon. So Amazon over here is a company that has been hit quite hard recently. The stock is down around 20% from all-time highs already. And year to date, it is down 9%. So it's a similar story to Google. At the start of the year, the stock went up and up and up, and then now it's back down as the market draws down as well. So for Amazon over here, it is currently trading at 35 times earnings, 31 times forward earnings. And in terms of business quality, I think Amazon is much higher quality as compared to Google. Maybe not much higher, but it is definitely higher quality than Google. So if you're to look at Amazon over here, the revenue has been increasing quite fairly, and the net income has been exploding for Amazon. So for Amazon, what they're trying to do now is they're trying to shift from growth to profitability. That is what Andy Jassy is doing. That is what he has been doing, and that's why you see all these different such an explosive net income growth, because they're trying to increase margins on all the different components that they have, which they have already been doing already. So for instance, in 2023, they had a 2.4% operating margin on everything else apart from the AWS. The AWS, I believe, was around 20%. And fast forward in 2024, the AWS service has around 37% operating margin. Everything else had an operating margin of around 5.4%. So for Amazon over here, all they have to do is just increase the operating margin by a few percentage points here and there, maybe increase it to around 7%, and this is easily a $220 stock already. So again, if you're to look at the valuation, Amazon right now is trading at a PE that is the lowest in its history. And for me, I think Amazon is it's a quality business that I'll be looking at right now. So for Amazon over here, if let's say your EPS is around 5.53 currently, and if let's say it can grow around 20%, which is what the analysts are sort of forecasting over the next few years, assuming it holds the PE of around 30, you are basically seeing a 16% CAGR over the next few years, which I think is extremely achievable for Amazon if they can sort of like just increase their margins. But for me, I am more comfortable with a 15 EPS growth, and that is around a 11% CAGR for Amazon. And that is assuming there is multiple contraction of more than 10% as well. So I think Amazon is hovering between the fair value and undervalued range, but I would put it closer towards the undervalued. Next company is Microsoft. So Microsoft currently is trading at around 31 times earnings, if I'm not wrong, correct? So it's trading at 31 times earnings. And over the past year, Microsoft is actually down. So it has had one completely flat year, and it is basically now at its 52-week low already. So for this stock over here, if you're to look at the fundamentals are just incredible. They grew earnings, they grew revenue in 2022 during the stock crash, in 2020 as well when we had a recession. And then overall, I think this company is just amazing. It is an extremely predictable business. It is one of the highest quality businesses out there in terms of predictability. And so I think paying up for it is definitely reasonable. So again, if you're to look at the valuation of Microsoft, the lowest point it has ever been at is around a 26 times earnings. So 26 times earnings over here. So for Microsoft over here, 12.4%, 12.41 EPS, assuming it can grow its EPS at around 14%, which is what I calculated based on their capex and the reinvestment rate, assuming all of that pays off, and assuming a 26 times earnings for Microsoft, Microsoft today will yield you around a 10.65% CAGR over the next few years. So as you can see, Microsoft is a company that is not extremely undervalued, although it has a flat year already, but I think it is around fair value now. So I'll be comfortable adding to Microsoft because of the business quality, but I hope it goes a lot lower so that it goes to around the undervalued range, where I'll be loading the boat on this one. Next company that I'll be talking about is Mastercard and Visa, this duopoly over here. So Mastercard and Visa are extremely high quality businesses. I believe they are the top 5 in terms of business quality in the entire world because they don't have any credit risk, they don't have any expenses. All they do is they just act as a toll gate. So whenever you use their card, you just pay them money, and then you pay them a small portion of basically inflation. So as we have inflation, they will benefit. As businesses grow, they will benefit. So it's sort of like a royalty business. So for this company over here, Mastercard, for example, is trading at around a 38 times earnings, 33 forward earnings. And if you have to look at the fundamentals of this company, I just can't believe how incredible they are. Mastercard is growing at 12% organically over the past few years already. Maybe it is due to consumers being more able to spend because they came out of sort of like COVID in 2020. But For Mastercard over here, if we don't go into a recession, I believe they can still continue growing revenue at around 12% every single year. And you add that with the take rate, which is around 4%, that is already a 16% growth for from Mastercard already. So as you can see over here, yep, so the EPS grew by 17% last year. Net income grew by about 15%. If you look at Visa as well, Visa is a similar story. It is growing revenue at around 10 to 11% every single year. And then they have a buyback yield of around 3%. That is an EPS growth of around 14% already. So for Visa and Mastercard over here, although they're not trading at extremely low valuations, so Visa over here is also trading at around a 33 times of earnings, I think they are both considered around fair value now. I would love for them to go a lot lower, like they did back in September of last year or July of last year. But I think they are extremely durable businesses. Even after the stock market crashed 10%, these stocks are barely even down. In fact, they're still up year to date. And so hopefully they drop a lot more. That's where I'm at. But for now, they are fair value. Next stock, Apple. So Apple is one of the most loved stocks in the entire stock market. There's a company growing at around 3% organically, and it's trading at 34 times of earnings. So if you to look at Apple's revenue growth over the past few years, it's been basically flat. So it's growing at around 2%, and the only thing that is propping up the share price is their buybacks. So as you can see over here, the EPS dropped by about 2% year on year, and yet the stock is still up around 20% in the past year or so, I believe. Yeah, correct. So 24% in the past year. All this came from just multiple expansion. So I think for Apple now, it's extremely simple. It is a company that lacks innovation. It is a company that is extremely overpriced. It is a company that has no growth. So for me, Apple now is a sell. It is higher quality than Palantir for sure. It is a lot more predictable than Palantir for sure. But the valuation is a problem. The growth is a problem. So when you have valuation and growth problems, I think it is a sell. So Apple is in the sell category. Next stock that I'll be talking about is S&P Global. So S&P Global is basically a credit rating service. So they have two different businesses. They have one that is the credit rating, and then the other portion, which is the data. So the data portion, they have the market intelligence, they have the mobility, as well as the commodity insight. So in each one of those segments, they hold around 20% market share each. So it's not extremely high quality, but it is a durable business that's growing around 10% organically. So they have this portion over here, which is your credit rating. So the credit rating portion is the extremely high quality one. They share a duopoly with another company called Moody's. So whenever you have companies like MSTR trying to get loans from people, get debt and all that, they need to get it rated first. And the only way for them to get them rated is to go through these two companies, as well as a third company called Fitch. Fitch holds around 10% only, so let's just ignore that one. So you have S&P Global as well as Moody's. S&P Global has around 40 to 45%, Moody's has around 30 to 35%. So for this company over here, it is currently trading at a valuation that is quite reasonable, I feel. So it is currently trading at a price to free cash flow of around 26 times. And if you're to look in the past 5 years, this is actually one of the lowest points when it comes to its price to free cash flow. So of course, a company trading at one of its lowest points doesn't really mean anything. But if you're to look at just the growth of this business, it is growing revenue at around 11% every single year. And it is a company that has grown the net income by around 46% over the last year. So in 2023, the net income actually dropped because of the record high interest rates, the record speed that we went up in terms of the interest rates. And so now we're recovering from that phase and we're going back up again all the way until 2028, where the debt maturity wall will end. So the debt maturity wall will end in 2028. So between now and 2028, I expect this company to grow extremely quickly. Same thing for Moody's. So for this company over here, if you're to just look at a valuation, so for this one, let's put in the 17.83 free cash flow per share. And let's say if it were to grow maybe just a 12% in terms of its free cash flow over the next few years, assuming a 26 times price to free cash flow, which is its current free cash flow right now, this company trading at around a $486 price will give you around a 11 to 12% CAGR. So I think for S&P Global now, it is hovering between fair value and undervalued, but I would lean it more towards the undervalued range because it is a quality business, one of the top 5 businesses out there in terms of business quality as well, apart from Mastercard and Visa. And so I think for the business quality, definitely paying up for it is fine. Next company that we'll be talking about is Tesla. So Tesla over here is simple. The problem with Tesla is no one cares about the fundamentals of the stock. So no matter how this company grows, how much this company grows, if this company just grows 1% year on year, no one cares about it. The only thing that people care about it is just stories. So you have this company over here trading at 122 times earnings, and for me it's simple. It's just, yeah, that's all. Sell. So I wouldn't touch this company. Maybe if it drops low enough, maybe just for a fun trade here and there, to just believe in Elon Musk, like what all the Tesla bulls will say. Maybe I'll buy into it just for the fun of it. But for me, I don't like these types of companies whereby they just trade simply on stories without growing its actual fundamentals. And for Tesla, every single earnings report, no one is actually looking at the fundamentals. Everyone is just thinking about the story, the robo-taxi story, the Optimus story, and no one actually looks into the numbers for this company over here. So avoid for me, I'll sell it. Next company is ASML. So ASML over here has been hit really hard recently. At its all-time high, it was around $1,100, and now it's almost half the price already. So for ASML over here, it's currently trading at 35 times earnings, 28 times forward earnings. And for this company over here, if you believe that this AI boom can just continue going on and on and on, then ASML will definitely be a beneficiary of it, because it is the only company in this entire globe that is able to produce your EUV machines. And your EUV machines are what is extremely important for you to produce high cutting edge chips to sort of like power all your different data centers and all your AI infrastructure and all that. So for ASML over here, I think it is an incredibly monopolistic business. And if you're to just look at the valuation over here, so the EPS is around 19.92. And assuming the middle estimate of its guidance in 2030, which is around 14% CAGR, and with the dividend yield of around 0.88, the current price at 30 times of earnings will give you around a CAGR of 11%, I believe. Correct. So it's around 11% right now. I think for ASML, it is around 10% undervalued. So simple. It's in the undervalued category for me, although it's only 11%. I may be a bit too pessimistic in terms of my EPS growth over here. Analysts are projecting around a 25% EPS growth over the next 3 years. I'm putting it around 14%. So if you're to just follow the analyst over here, assuming it's 25%, that is a 21% CAGR over the next 5 years. That's just incredible. But for me, 14% is fine. 14%, 11%, that is market matching. And assuming they have more upside in terms of AI, I think this company over here is undervalued. Last company on the list, Costco. So Costco over here, the problem with this business, right, it's not the actual business itself. It's a company that is growing extremely steadily. So 6% revenue growth, 10% revenue growth, growing net income by around 12% every single year. Extremely durable business. You will still see this company doing well even in a recession, because people will still have to buy their groceries, people will still have to pay for the Costco membership. But the problem with this business is it is trading at a 52 times of earnings. So if you're to just look at the valuation in terms of looking at it compared to the past, a lot of the growth in the stock price is because of the multiple expansion. So as you can see over here, it has grown from around a 38 times earnings to a 52 times earnings now. So for me, Costco is simple. It's extremely overvalued. I wouldn't be touching it right now. It's a company that is overvalued. So I wouldn't necessarily sell it because the business quality is there. But for me, it is hovering between overvalued and sell for me. As yeah, this company is trading at 50 times earnings, and there are much more better opportunities out there. You can probably get one of these companies over here at a much cheaper price compared to Costco. So for me, I will wait until the company goes to around 30 to 35 times of earnings, and that will be when I buy into this business. This business is extremely amazing. I went to Australia, my family, I went to a Costco store. It's amazing. It's completely packed, but valuation is the problem.